Welcome traders. In this video we're going to go over the reversal trade pattern. A reversal trade occurs when price trades through a trend trade and then reverses and trades to an intermediate zone of support or resistance. Okay, so the first thing that has to happen is a trend trade. The trend trade occurs when price trades to any blue counter trend zone. This can be either a counter trend trade or an exhaustion trade. Price will then trade to the opposing intermediate zone and trade through that zone. We generally want about 4 ticks to trade through the intermediate zone on a 150 tick chart. On a 500 tick chart, I boost that up 1 to 5 ticks. We count the ticks based upon where the zone starts. For a long trade, as in this example, the area that we start to count the adverse excursion starts at the top of the zone. And if we have a short trade, we start counting at the bottom of a zone. Anytime ZoneTraderPro makes a statistic, it's based upon these areas where maximum favorable excursion and maximum adverse excursion start. After the adverse excursion of the trend trade, price is going to reverse to the opposing intermediate zone. Now we have a reversal pattern. Don't count on always seeing the trend trade. The software has logic written into it so that a trend trade that occurs after an exhaustion or tick divergence pattern doesn't show up. Be prepared for this, and this is part of the reason why we do the training to understand when a trading pattern occurs, whether or not you see it on the chart or not. To set up the charts, there's only 2 settings. Minimum distance from the counter zone refers to how close price needs to trade to the counter trend zone in step number 1. Trade through intermediate zone is the setting of how far through the intermediate zone we need to trade in the trend trade that fails in step 2. So why do we use 2 charts? Just like in the other patterns, we want to look at a 500 tick chart before going into a trade, because the 500 tick chart removes some of the noise and also sometimes provides an exit target. We also use both charts to verify that there is not a high risk pattern, such as a strong trend trade occurring on either chart. In this trade, we're going to be looking at what is marked as an exhaustion trade on the 500 tick chart, and that is not indicating anything that is high risk. The reversal trade is on the 150 tick chart, and as we look at that, we see nothing that is high risk there either. And so to sum it up, we're going to use both charts to eliminate trading signals if either of the charts indicates that there is additional identified risk. We can also see reversal trade patterns on the 500 tick chart, and when they are identified, these are excellent trades because they provide a larger point target and thus more reward for less risk. It gives us the big picture, and it's extremely valuable to develop a target such as the next zone. So what are the risks when trading a reversal trade pattern? We use 2 charts for a reason, to identify when there is high risk on either chart. So this is a 500 tick chart, and if we had developed a pattern on the 150 tick chart, we would then reference this 500 tick chart to see if there was any areas of high risk. When referencing this area, there would be 2 areas on this chart that identify high risk. The first is the high risk strong trend trade at the top, and the second is the high risk strong trend reversal on the bottom. If either of these two patterns were occurring when we were given a reversal trading signal on the 150 tick chart, we would then avoid taking the trade on the 150 tick chart. And just to do a quick refresher, a high-risk strong trend trade is defined by price trading to the pink counter trend zone, and a high-risk strong trend reversal is defined as when price trades from a blue zone to the opposing blue zone. In this case, it doesn't matter that price had traded even higher than the counter trend zone. So the setup for this trade is quite simple. First, we verify that we have no high-risk patterns on either chart. Then we have a trend trade that fails. Preferably, this trend trade occurs after an exhaustion or a tick divergence pattern because this is indicating a market reversal. And then price returns to the intermediate support zone and the trade is signaled. The next thing we want to look for is our point and figure chart, where we want to see divergent delta strength. In this chart, the divergent delta strength we were looking for was the red down bar with the green 324, indicating that ZoneTraderPro delta strength indicator had found divergent delta strength. Also important to note that on the previous tick divergence trade, there was also divergent delta strength with the number being 246. And it is also really important to note the subsequent delta strength bar after the reversal pattern was an extremely significant 9,650 contracts, meaning that there was an extreme amount of buying going on in that bar. The delta strength tape reconstruction filter setting for this chart was set at 75. So these are representing trades going off with the order size being 75 or more. This is a feature only found on ZoneTraderPro and not any other software. It is 100% completely unique to ZoneTraderPro. The last thing we look for is we look to the order flow chart to see that we had order flow and to see good delta strength at the point of the trade, which we did. It is extremely interesting to see this chart because of the strong buying that occurred all the way up and no opposing order flow signals until you reached the top. When we have all the requirements of the setup and they're met, you can see a 17-point move like this one from this example that we just talked about. I'd like to thank you for watching this short video on the reversal trading pattern. And if you should have any other questions or comments, please give me a call. Thanks and have a good trading day.